Hello, everyone, and welcome to Gen Z Talks Money. My name is Samuel Kim Boyer II, a 15-year-old high school student who will be guiding you on a financial literacy / financial management course for the next few months. Thank you guys for joining in. Alright, so on episode 1 of Gen Z Talks Money, we will be discussing the very basics of the stock market and addressing the questions of what exactly you need to do, what exactly you need to know, what exactly you need to set up with your parents or just by yourself to get into the game that the stock market is. So to begin, we need to answer the very basic question of what exactly a stock market is. A stock market is an exchange on which shares of a publicly owned company are both bought and sold. And to break that down, to go a little bit more into the vocabulary here, a publicly owned company is a company like, say, Apple, Google, Amazon, Microsoft, companies like that create these units, these fractions of ownership in the form of stock and allows the public to buy them. So hence the name publicly owned company. So for example, I personally am a shareholder of Apple, which means that I have some stock that gives me the right to own that company. So when you think of share, when you think of stock, think share of ownership in a given company. That's what a stock is. And considering that all that a stock really is just a representation of the percent you own of a company, then you can think of profiting in the stock market as just trying to select the best, the most healthy, the most profitable company that you possibly can. Because when you own shares of stock, so when you have ownership in a company, it's just another way of saying that, then the more that company generates revenue, the more profitable that company is, the more successful that company is. That means that owning, right, ownership in that company is going to become more and more valuable the more it is successful. And that goes just the same to the opposite. So if you were to own a company that does very poorly, that does not generate enough revenue to please its shareholders, then the value of your ownership, your personal stock in that company is going to go where? It's going to go down. So when you think about it that way, that is in summary all that the stock market really is. So now that we have a very basic definition and a very basic conception of what a stock market is and what stocks are generally, we can finally start to ask ourselves the question of where is the money? How do I start buying and selling stocks? How do I start profiting from the knowledge that I have? And the first thing you're going to want to do to answer that question is to open up what's called a brokerage account through a brokerage firm. And to give you a very brief summary, what a brokerage firm is just a financial institution. So it's a company that is brokering or carrying out the stock transactions that you have. So all of the buy and the sell orders that you will give your brokerage account, that you put into your phone, that you type into your phone, right? The brokerage firm is going to be the one that's directly carrying those things out on the exchange and is going to be buying and selling the stocks that you want to buy and sell. And there are various options for brokerage accounts. I would say hundreds, very many possibilities. And I advise you to research each one in depth to really determine what is best for you, what meets your investment goals and your investment needs. But for the average person, I would personally recommend something like Charles Schwab and Vanguard, which I have indicated with the crowns, because I feel those give some very nice features, especially for beginners, that help understanding, as opposed to some of the others like E-Trade is definitely for more experienced options traders, if you will, giving them a lot more advanced tools, things like that. Fidelity is also a good option. Webull and Robinhood, again, those don't have too much respect in the industry, but both of them are pretty sound. I know Robinhood now offers like a 1% match of all the contributions you make to your account. Interactive Brokers is great. Acorns, it I saw it on TV. It like rounds up the the cent amount in your order and invest that too. So all great options. All you really need to know is that everything I have on the screen, its main purpose is just going to be carrying out the buy and sell orders that you put just into your phone when you establish an account. And that is what a brokerage account is. So once you have chosen a brokerage firm that you want to invest through, you're going to need to get with your parents, work with your parents to create a specific type of account called a custodial, technical name being a UTMA, which is a Uniform Transfers to Minors account. And essentially what this is that it is a trading slash investing account that is under an adult's name for a minor until they turn 18, and the account legally transfers ownership to them with all of their information. So once you have set up your custodial account with a parent, you can finally begin investing. And there are very many ways to invest, as I've laid out here. There are ways like dividend investing, growth investing, value investing, momentum investing, fixed income investing, and of course, investing through individual stocks. And while all of those ways can sound very complex and very advanced, I have laid out what I personally believe to be the easiest and the most effective way to invest, especially for beginners, in my formula for success, which consists of three main principles, three main components that you need to follow to successfully invest. The first being index investing, the second being dollar cost averaging, and the third being adapting a buy and hold mindset. And when you do those three things, when you follow those components, you are setting yourself up for a favorable outcome in your investing. And in the rest of this presentation, we will be talking about each three of these components in depth. So, the first component of my formula for success is index investing. And index investing is basically a strategy where you invest in what are called index funds. And what an index fund is a basket of stocks. So as you can see down here, we have a basket of stocks that contains a bunch of big name companies. As you can see here, we have the likes of Facebook, Amazon, Microsoft, Alibaba, Google, Apple, and hundreds of more big companies. And what this basket of stocks does is that, say you invest $500 in it, that $500 becomes distributed among all of those companies. So it's a lot easier to invest in the basket, in the index fund, than to invest in each and every one of those stocks individually. Now, what I have above is a list of the major index funds. These big index funds that you are most likely going to start off investing in are the S&P 500, the NASDAQ Composite, the NASDAQ 100, which just takes the biggest 100 stocks in the NASDAQ Composite and makes kind of a smaller index fund with them. You also have the Dow Jones Industrial Average, the Russell 2000, and the Russell 3000. All of the index funds I mentioned before are very useful tools to get you something called diversification in your portfolio. And what diversification is essentially is just owning so many stocks, owning many stocks, which basically gives you protection against one of those stocks performing badly. So, for an example, say your portfolio, all of your money consists of just Apple. So all of the money you have is in Apple, right? So then say Apple has a bad quarter, they have bad earnings, investors are upset with the company, so the company starts to sell off. Well, because all that you own is Apple, you are going to suffer a lot more than somebody who also owns Apple but owns a bunch of other companies that may be thriving when Apple is not. And that is what index funds allow you to do, and that's why they are so useful and the first step in building that formula for success. But unfortunately, you cannot directly invest in the index funds. So instead, you need to invest in securities, you need to invest in assets that track them, that closely follow them. And the two ways you can do that are ETFs and mutual funds. So ETFs are passively managed, while mutual funds are actively managed. So ETFs allow investors to buy many stocks or bonds in certain market segments at once. So for instance, you could buy an ETF to get exposure to electricity, and utilities. So you could buy a basket that holds a bunch of electric companies. You could buy a basket that holds a bunch of technology companies. So they're good for sector exposure. ETFs are traded on an exchange like stocks. So you could just pick up your phone, pick up your brokerage app, and invest in these ETFs very easily, just like you would invest in, any companies that you can think of. And ETFs are traded whenever the stock market is open, so prices are going to continuously fluctuate. And that's pretty self-explanatory. Of course, the ETFs, which track the index funds, are going to be open all day. And the difference of ETFs with mutual funds is that mutual funds are more actively managed pools of money. So say I'm a mutual fund manager. That means you give me your money and I invest it for you. That's what a mutual fund is, but it typically comes with a lot of fees and doesn't really allow you to be independent with your money. So ETFs are going to be the king of this. You are going to invest in ETFs, or exchange traded funds, that track index funds. And when you do that, you are going to have the benefits of diversification, and you are going to have the first component of the formula for success. So for some specific examples of ETFs, exchange traded funds, that you can invest in today, I listed out some of the most notable ones, some of the ones that are most actively used, and those are going to be the VOO, the DIA, SPY, QQQ, XLK, SPLG, IVW, and IVV. And all you have to do to access these ETFs is that you need to go to wherever you're trading. So your brokerage app, you click trading, and then you type in these symbols, and they're technically called ticker symbols. So like all of these stocks, all of the companies that are listed on an exchange, they have ticker symbols, which are like their stock's name. So it's just kind of a shortened name to refer to the stock. So that's what you're going to have to do. You're going to have to type in these ticker symbols of the ETFs so you can get investing. Now, the second step of my formula for success that I laid out is called dollar cost averaging. And it may sound very advanced, but it's really quite simple. And basically all that dollar cost averaging is that it is an approach to entering a position. So it's an approach to buying a stock over time instead of all at once, to average out the cost of the position. So to explain what that means, it's a lot easier to show than to tell. So that's why I have an example here of a price action chart, so of a chart of a stock, and then a dollar amount, which is $100,000. So let's say that you did not dollar cost average, you did not spread out your position over time. Let's say you just put $100,000 in this dot right here that I'm hovering below with my cursor. As you can see, over time, the price of the stock went down, and you would have lost a whole lot of money. That is, I would say, at least a 20% drop from when you invested $100,000. So you would have lost 20K just like that. Versus somebody who, instead of putting all of their money, all of the $100,000 in at one time, invested it over time in smaller payments. So for example, instead of just having one dot, you now have 20 dots. Okay? And with these 20 dots, you invest $5,000 each. So you break that $100,000 into smaller amounts. And what that does is that it rounds out those peaks, it rounds out those bottoms, and gives you an average price, as you can see marked here, which ultimately results in you having less exposure to massive downside moves. So with the dollar cost averaging approach, there is less exposure to you losing your $100,000 immediately, and therefore there is greater opportunity for you to gain over the long run, or for you to stay in the game for a longer period of time, which leads in perfectly to the next and to the very last component of my formula for success, which is actually a mental paradigm that you need to adapt. And that is the buy and hold mental, emotional, whatever paradigm, which essentially says that the longer you allow your investments to accumulate dividends and to have time, right? The more time you give your investments, the more and more they will grow. And to illustrate this, as you can see here, I just have a chart of the Standard & Poor's 500 index, the S&P 500 index, all the way from January 4th of 1960 through October 27th, 2023, which isn't exactly up to date, although it was quite close. And as you can see, despite all of the conflicts our society has been through, despite all of the recessions, right, in that period of time, despite all of the downturns, the S&P 500, which is reflective of the broader United States economy, has proven to do one thing, and that one thing is to simply go up. So a bet in the bullish direction, right, a bet in the positive direction over the long term is essentially never a wrong one. And as you can see here, I have the statistics to back that up, in that the greater your time frame, the greater your probability for profit. So for instance, and I calculated all of this from a historical statistical approach to this, your 1 day probability of making money, so say you made an investment, the next day, the probability of you making money off that is 50%, which is a coin toss. 1 year after that is 68%. 10 years after that is 90%. So already a very significant increase. And then 15 years after that, 100%. So statistically, there is a 100% probability of you making money after a 15-year period, which just shows the power of compounding and shows the power of giving your time, giving your ideas, giving your stocks, giving your portfolio time to run, time to prove itself, time to make money. And this is contrary to the other type of investing, if you will, which is all about timing the market, which is all about getting in, all about getting out at the right time. But an iron rule of personal investments, personal financial independence, is that it's not about timing the market, it's all about time in the market. The more you spend in the market, the more you're ultimately going to get from it. And that is backed up by another shocking statistic, which basically shows the returns, okay? Which basically shows the returns you would have in your portfolio, assuming it's an index funds that tracks primarily the S&P 500, if you were in it the whole time versus if you weren't in it for just the best 10 days per decade. So basically what that's saying is that, let's say you're trying to actively time the market, you're trying to play it, you're trying to get in at the lows, you're trying to get out at the highs. Well, let's assume, which is very likely, you missed out on some of the best days in each decade. And this statistic is basically showing how that would influence your ultimate performance of your portfolio. And as you can see here, the returns are tremendously different, absolutely tremendously different. So as you can see here, from all the way up until 2020, assuming you were in the whole time, through the thick, through the thin, through your periods of famine, through your periods of feasting in the stock market, you would have an estimated 17,715% total return. And keep in mind, just a 100% return is 2 times in your money, okay? So in that period, you made quite a bit. While if you took away just the 10 best days per decade, only 10 of those best days, well, now you only have a 28% return. I mean, this is an absolutely astonishing statistic, and what it shows comes back to this right here. It's not about timing the market, it's about time in the market, right? The more your bait is in the water, the more you're going to be catching fish, and that's what it's all about. And finally, to conclude, thank you all so very much for watching on the first episode of our financial freedom, financial independence journey on Gen Z Talks Money. And for this video, I actually have a challenge, and that challenge is to talk to a parent or a guardian about an account over dinner, in the car. Sometime when you see a parent or a guardian, just talk to them about investments, talk to them about finance, and try to show a little bit of interest in maybe opening an account, which can be really your first step towards that financial independence, towards that financial freedom, that financial understanding that we all want. Thank you very much. This has been Samuel Boyer II. I'll see you next time.